Today, we are excited to hear firsthand from Sandra Lee, the Deputy Assistant Secretary for FSOC in Treasury. Established in 2010 under the Dodd-Frank Wall Street Reform and Consumer Protection Act, FSOC is charged with identifying risk to the financial stability of the United States, promoting market discipline, and responding to emerging threats to the stability of the U.S. financial system. In her role, Sandra leads and manages the Office of the FSOC, monitoring risks to the U.S. financial stability, preparing research and analysis at the request of the Council, and coordinating the work for the Council's interagency committees. Prior to joining the Treasury, Sandra was a Senior Vice President and the Director of Policy Planning Office at the Federal Reserve Bank of New York. She also worked in its legal group. Before the New York Feds, Sandra was actually one of the initial staff members to establish the FSOC, employee number 3, in fact, and she helped to publish its first annual report. So she's the perfect person to share with us Treasury and FSOC's effort to address climate as a systemic financial risk. Sandra, thank you so much for joining us today. The floor is yours.
Can you hear me, Holly? Okay, great. Thank you, Holly, for that kind introduction. And thanks very much to Ceres for having me here today. I'm really glad to be here. I really appreciate the opportunity to share an update about the FSOC's work to address climate-related financial risk. So as Holly noted, by way of background, the Financial Stability Oversight Council was established pursuant to the Dodd-Frank Act in 2010, and its mission is to respond to emerging threats to the stability of the U.S. financial system. The Council's duties are broad and include, among other things, monitoring the financial services marketplace to identify potential threats to financial stability, making recommendations to enhance the integrity, efficiency, competitiveness, and stability of U.S. financial markets, and facilitating information sharing and coordination among Council member bodies. Since 2021, the FSOC has made addressing climate-related financial risk one of its key priorities. As many of you know, in October of 2021, the Council published its report on climate-related financial risk in response to a directive in Executive Order 14030. In that report, the Council stated for the first time that climate change is an emerging threat to U.S. financial stability. The report issued 35 specific recommendations to U.S. financial regulators on how to identify and address climate-related financial risks and to promote the resilience of the financial system to those risks. Since the report's release, the Council and its members have been implementing the recommendations in the report. As outlined in that report, the Council had recommended 1, building capacity and expanding efforts to address climate-related financial risk, including making internal investments to expand capacity to help define, identify, measure, monitor, and report on climate-related financial risk. 2, filling climate-related data and methodological gaps to ensure consistent and reliable data to assist in assessing climate-related financial risk. 3, enhancing public climate-related disclosures to promote the consistency, comparability, and decision usefulness of information on climate-related financial risk. And 4, assessing and mitigating climate-related financial risk to financial stability, including using scenario analysis as a tool to address those risks. So to help facilitate these efforts, in February 2022, the FSOC formed a new staff-level committee, the Climate-Related Financial Risk Committee, or the CFRC, which serves as a very active forum for interagency information sharing, coordination, and capacity building. This capacity building within the FSOC has been critical and has promoted greater communication and coordination among staff working on climate-related financial risk across all the Council's member agencies. The Council also recognizes the need to engage with the public and experts on climate risk issues. So in March of 2023, just in this year, FSOC established its first external advisory committee, the Climate-Related Financial Risk Advisory Committee, also known as the CFRAC. We love our acronyms here, to assist the CFRC in gathering information on, conducting analysis of, and making recommendations to identify, assess, and mitigate climate-related financial risks to the financial system. The CFRAC is composed of a diverse range of experts, including from the financial services industry, NGOs, climate-related data and analytics providers, nonprofits, and academia. And as part of our efforts to provide additional transparency about our work, the FSOC earlier this year in July released our first staff progress report outlining agency progress on climate and the work of the CFRC. The report reflects on the CFRC's work to develop a framework to identify and assess climate-related financial risk and develop a preliminary set of risk indicators. This is very much an interagency effort to bring insights and data together, pool resources, and avoid duplication of effort. The risk indicators and framework will deepen the agency staff understanding of climate-related financial risk. The proposed risk framework starts with physical and transition risk drivers, assesses how these risk drivers translate into economic impact, and identifies the transmission channels from these economic impacts to the financial system. The ultimate aim of this proposed framework is to provide a tool for identifying vulnerabilities in the financial system through assessment of the financial system impact of these physical and transition risk drivers. To advance its goal of developing risk indicators as part of an overall risk assessment framework, staff have formed 3 work streams on banking, insurance, and financial markets. Each of these work streams focuses on a specific sector of the financial system, but all 3 work closely together because the interplay among banking, insurance, and financial markets may amplify climate financial risk. The banking workstream, for example, has reviewed how climate-related risk drivers can manifest as and amplify traditional risks, including credit, liquidity, market, and other risks. For each risk category, agency staff are then developing relevant key risk indicators and sourcing relevant data. For credit risk, as an example, we're developing indicators related to total loan balances of mortgages held by banks that are exposed to acute physical risk. We're considering current as well as forward-looking exposures, recognizing the difficulties of forward-looking analysis and making assumptions about future policy pathways, expected climate impacts under different emission scenarios, and mitigating measures taken by households, businesses, and financial institutions. These risk indicators are in early development. Agencies face challenges related to data gaps and fragmentation, inconsistencies in measurement techniques and assumptions, and limited research exploring the financial stability implications of climate-related financial risk. Given these challenges, identifying and monitoring climate-related financial risk indicators will be an iterative process that will develop over time, but will continue to be a priority area of focus for the Council. In addition, as part of our future analysis, member agency staff are particularly focused on the intersection among physical risk, real estate, banking, insurance, and household finance. Increases in the frequency and intensity of climate disasters can lead to sharp falls in property prices and incomes in certain areas, impacting households and financial institutions. At the same time, several large insurers have stated that they are stepping back from providing home insurance coverage in certain states, contributing to the increasingly precarious state of property values in areas hardest hit by climate change. Understanding the impact of these market shifts, their potential spillovers, and how to respond to these changes is critical for building resilience to climate risk in the financial system. We look forward to continuing to advance this work and listening and learning from external stakeholders as we press ahead on this key priority. With that, Holly, happy to turn it back to you. Thank you.
Thank you for the informative remarks, Sandra. We understand that you're super busy and need to leave now, but we really appreciate your leadership and the Treasury's leadership on this issue. Thank you. Now, Kelsey is one of the co-authors of the Climate Risk Scorecard. They provide work on issues related to federal financial regulators, including the Federal Reserve, OCC, FDIC, and FHFA, to address systemic climate-related financial risk through management and supervision frameworks. Kelsey also authors many of our technical submissions to these agencies' requests for information. Before Ceres, Kelsey worked as an associate attorney at the whistleblower law firm and representing whistleblowers in administrative actions, litigations, and advising on environmental issues. Kelsey, thank you for your insight. The floor is yours.
Thank you, Holly, and thank you to our speakers and audience for being with us here today. So just a brief overview again, climate-related financial risk permeates capital markets, similar to cybersecurity risk and the coronavirus pandemic, posing threats to financial institutions and markets of all sizes, business models, and geographies, as well as the communities that they serve. Due to the interconnectedness of the U.S. financial system, interactions between risks or compounding effects of multiple concurrent or consecutive climate events could trigger cascading systemic risks or macroprudential contagion, impacting and undermining the integrity of the entire U.S. economy. The collapse of 4 U.S. banks earlier this year demonstrates just how quickly unmanaged risk can sweep through our financial system. And climate-fueled extreme weather events are increasing both in frequency and severity. According to the National Oceanic and Atmospheric Administration, or NOAA, there were over 20 separate climate disasters where losses exceeded 1 billion in 2021, 18 in 2022, and as of December 8th of this year, there have been 25 climate disasters with losses over 1 billion. Overall, the events in 2023 have resulted in the deaths of 482 people, over half of which were caused by heat waves, and had significant economic effects on the impacted areas. Systemic climate-related financial risk can be broken down into physical and transition risk. Physical risk encompasses financial losses due to the loss or devaluation of physical assets from climate-related events. For example, the 28 largest U.S. banks have more than $250 billion exposed to physical risk, even if adaptation measures are taken, with about 2/3 of this risk coming from indirect economic impacts like supply chain disruptions and lower productivity. Transition risk encompasses financial losses as markets move toward a low-carbon economy, resulting in declining asset prices, revenue and profitability in carbon-intensive sectors. For example, more than $500 billion, over half of major U.S. bank syndicated lending, is exposed to transition risk, and bank leverage and connectivity with the financial system could lead to significant losses for the broader economy. Both physical and transition risk also impact traditional risk categories such as operational, credit, market, and liquidity risk, which regulators and their regulated entities should be aware of and understand. As noted in a recent Ceres report on sustainable finance opportunities, while the risks from climate are serious, the transition to a low-carbon economy also provides enormous commercial opportunities, for example, through green products and sustainable or resiliency solutions. Related to both physical and transition risk, socioeconomic risk encompasses financial losses as a result of climate impacts on the financial and economic well-being of individuals and communities, particularly financially vulnerable communities, that may implicate not only these communities, but the strength of our financial system overall. Internationally, at least 37 regulators and international bodies have begun implementing climate risk supervisory and regulatory policies, with at least 53 beginning or having completed climate scenario analysis or stress testing exercises. In the US, we have seen significant progress in the past several years at both the federal and the state level, although the current understanding of how the increasing frequency and intensity of climate risks will impact the US financial sector is incomplete. Which brings us to our 2023 Climate Risk Scorecard, our third assessment. The 2023 scorecard assesses 10 agencies that you can see here. We assess these agencies' progress from July 2022 through June 2023 in each category based on public reports and official statements and progress updates shared directly with us verbally or in writing. We employed a color-coded system to indicate the level of progress. Where an agency has no relevant authority in a specific area, we mark this category as not applicable. We connected with all 10 financial regulators assessed through meetings and email exchanges to discuss their results, and we thank the regulators for their time and feedback throughout this process and for their efforts throughout the year. To better document progress and to reflect ongoing agency commitments and areas in need of attention, we updated the scorecard and expanded the assessment categories from 6 to 9, drawing from 35 recommendations made in the FSOC report that Sandra discussed earlier. These new categories include 3, increasing transparency of climate risk management activities, 6, conducting climate-related scenario analysis, and bifurcating inclusion of climate risk in 8, supervisory guidance, and 9, regulation in 2 distinct categories to better capture regulator action. Categories 2, 4, 5, and 7 were also updated to more closely align with the FSOC report recommendations. So starting on our categories, number 1, similar to last year, all but 1 of the 10 regulators were assessed publicly, affirmed climate-related financial risk as a systemic risk to our financial system. This sends a strong signal to the market and public that these regulators both understand how climate-related financial risk may impact their regulated entities and that market participants should prepare to deal with those risks. Again, mirroring last year's update, 6 of the 10 agencies have robust internal climate-related capacities, but 2023 saw additional progress from those still developing their staffing and technical expertise, with the OCC establishing its Office of Climate Risk, the NCUA identifying 2 part-time staff chairing its climate-related financial risk working group, and the MSRB announcing its visiting scholars research on trends and the disclosure of ESG-related information, including climate risk. Importantly, all but 2 agencies improved transparency regarding their actions to measure and manage climate-related financial risk. This includes updates to websites, such as the OCC and FHFA's dedicated climate risk websites, as well as the announcing of staff and contemplated future actions, for example, through annual reports. Although this category was not assessed in the previous scorecard iterations, the need for transparency is threaded throughout each of the other 8 categories. Certain actions are only impactful when publicly and transparently shared with stakeholders, signaling to the market that those agencies understand climate-related financial risks to their industry and are ensuring the financial system is prepared for both physical and transition risks. Transparency also helps give the public an understanding of the process and reasoning of how and why regulators are addressing these risks, building trust in that oversight. For the period covered by the 2023 scorecard, only the FHFA and NCUA made significant progress in addressing the impacts of climate events on financially vulnerable communities. The FHFA's Consumer Protection Working Group within its Climate Committee developed an internal framework to address climate-related impacts on consumers, including historically underserved communities, and the agency incorporates climate considerations into its fair lending and equity policy analysis. The FHFA likewise worked with its GSEs to produce equitable housing finance plans and duty to serve underserved markets plans that incorporated climate resiliency targets and outcomes. At its annual DEI summit in November 2022, the NCUA hosted a panel on opportunities for credit unions to incorporate environmental justice and climate resiliency, and its 2023 RFI on climate-related financial risk also included discussion of the disproportionate impacts on low-income and minority communities. Since publication of the 2023 scorecard, the Treasury published a report on the impact of climate change on American household finances, which examines climate hazards to households, especially vulnerable communities, and how they could be mitigated. And the banking agencies published their final Joint Community Reinvestment Act rules, which include natural disaster and weather resiliency activities. Low-income and BIPOC communities are disproportionately impacted by climate events and are often least able to withstand the impacts, which may include disinvestment from climate-vulnerable areas. While the new weather resiliency provisions are not perfect, they're a critical step forward in addressing a growing risk that exacerbates economic and racial inequality and should help climate-vulnerable communities build physical and fiscal resilience. The agencies will also jointly issue an illustrative list of community development activities, which if it includes natural disaster and weather resilience activities, will help both banks and communities understand the benefits of these new provisions. While every agency should continue enhancing the breadth and depth of their research and data collection, we found that all 10 agencies developed their institutional knowledge on data gaps and climate-related financial risks to their regulated entities since June 2022. The Treasury and FHFA in particular advanced agency capabilities to obtain and analyze the interaction between climate risks and financial services, including impacts specific to vulnerable communities. Notably, the NCUA issued its first analysis on climate risk to credit unions, similarly noting the disproportionate impacts on disadvantaged communities. And the MSRB's visiting scholar focused on ESG-related disclosures in the municipal securities market. Since publication this summer, the OCC conducted a discovery review of more than 24 large banks to assess how they are accounting for the impact of climate risk on loan books and lines of business, preparing for a transition to a low-carbon economy, and using data and monitoring progress towards targets. The review was meant to set a baseline of bank climate risk practices. Critically, the Fed reached a milestone towards ensuring the safety and soundness of the U.S. financial system, conducting the federal government's first climate-related scenario analysis exercise with the nation's 6 largest banks to review how those banks currently handle climate-related shocks and where gaps in management may exist. Aggregate results from this pilot are expected at the end of 2023, so something to look forward to soon. While this is a significant step for the U.S. central bank, it's important to note that at least 31 regulators around the world have already conducted or are currently conducting scenario analysis exercises or stress tests of their supervised banks, allowing those institutions to more accurately measure their risks and assisting smaller banks in building out their own climate risk management frameworks. The FHFA has also begun to review and develop guidance on climate-related stress test scenarios, engaging with their GSEs to develop methodologies for acute physical risk measurement and analysis, as well as participating in FSOC's CFRAP workstream, or CFRC workstream on climate scenario analysis. The SEC has undertaken an impressive effort in its response to its landmark proposed rule that would require mandatory climate disclosure from public companies. The agency is currently in the process of reviewing a record-breaking 15,000 comments as part of its work to finalize this rule. Through FIO, Treasury has issued multiple data collection and disclosure calls to address climate-related data gaps in the insurance industry, as well as issuing a report analyzing climate-related issues and gaps in the U.S. insurance supervision and regulation. The FHFA's Climate Committee also includes a work stream dedicated to reporting and disclosure, and under FHFA oversight, the GSEs release SASB reports regularly. Highlighting the SEC rule in response to concerns and calls from investors, the SEC proposed a rule for mandatory climate disclosure that would ensure investors have adequate information on climate-related risks. The rule would facilitate consistency and comparability, and there is broad support among trades and major banks building on the TCFD framework. The rule will likely and hopefully be finalized in 2024. The SEC's climate disclosure rule is also the only regulatory proposal issued by the 10 agencies. Overall, the FHFA led the way in advancements this year, receiving the highest score in 6 assessment categories, including climate risk and supervisory guidance. The FHFA has been working with Fannie Mae and Freddie Mac to update their governance structures to include climate risk management and has included sustainability and resiliency initiatives in their annual scorecard expectations. The FHFA also plans to include climate risk examination guidance for evaluating the incorporation of climate risk into GSE and FHL bank decision-making. The SEC has likewise made substantial progress in this area, releasing 2010 guidance regarding disclosure related to climate change, 2021 sample letter to companies regarding climate change disclosures, and 2023 examination priorities, which include ESG disclosures and labeling as a notable focus area. Notably, the NCUA also took its first step towards potential guidance, issuing a request for information on how to bolster its ability to identify and assess climate-related financial risks faced by federally insured credit unions. Since publication of the 2023 scorecard, the Treasury published voluntary principles for net zero financing and investment to promote consistency and credibility in approaches to implementing net zero commitments and transition plans. And the CFTC published a request for comment on proposed guidance regarding the listing of voluntary carbon credit derivative contracts just this month. And this fall as well, the banking agencies also issued their final joint principles for climate-related financial risk management, which provides a high-level framework for banks with over 100 billion in assets. While the principles are guidance, not regulation, they provide the first step towards helping banks assess and address climate-related financial risks that may pose threats to a bank's safety and soundness. The principles are divided into 6 general areas where banks should focus their attention and are intended to promote a consistent understanding of effective management of climate-related financial risks. These principles are a foundational and very important step. So just briefly, Ceres has numerous resources on its website for both regulators and market participants on the risks and best practices associated with climate-related financial risk. And for more information on the agencies discussed here today, as well as recommended next steps, please visit our scorecard website at ceres.org/scorecard. We will also be sharing this deck with the linked resources, including a short scorecard website tutorial. And we will now be transitioning to a fireside chat with the chair of FHFA's Climate Change and ESG Steering Committee, Dan Coates. Dan serves as the Deputy Director of the Division of Research and Statistics, where he is responsible for using economics, research, and data analytics to enhance FHFA's regulatory policy, supervision, and oversight. He is also the executive sponsor of FHFA's Climate Change and ESG Working Group and chair of the FHFA's Climate Change and ESG Steering Committee. Dan represents FHFA at the FSOC's CFRC and NGFS and the Mitigation Framework Leadership Group, which is chaired by FEMA. Since 2018, he has served as the chairman of the FHFA's Reference Rate Transition Steering Committee, which oversees the agency's regulated entities' transitions away from LIBOR and other reference rates. Before joining FHFA, Dan served as an associate director, leading the Division of Research at the Federal Housing Finance Board, and spent 10 years at the U.S. Government Accountability Office. He has a PhD in economics from Columbia University and an MA and BS in economics from the University of Delaware. Dan will be speaking with Stephen Rothstein, the founding managing director of the Ceres Accelerator for Sustainable Markets. Stephen has 40 years of experience starting, managing, and growing several nonprofit, social change, and government organizations, has worked at state, local, federal, and international levels of government, and has served on many nonprofit and government boards. He has spoken and written extensively and worked with partners in the corporate, nonprofit, and government and philanthropy sectors. Stephen has a BA in political science from Williams College and an MBA from Northeastern University's DeMoore McKim School of Management. Thank you both for being here with us today, and I'll pass it to you, Stephen.
Kelsey, thank you, and thanks to Holly and Sandra and everybody else who's been on this. Thanks to the Ceres team behind the scenes that are working on the support. I also want to just recognize Monica Barros, who co-authored and did a great role in the scorecard itself, and all the other staff. So, and clearly, Dan, the FHFA plays such a critical role. Can you just talk about what you've done and under leadership of Director Thompson in terms of why climate is important, what is the agency doing, and your GSCs, government-sponsored entities, and the Federal Home Loan Bank, and just as an overview, and then we'll go into more detail. But again, Dan, with thanks for being here and for all that you're doing. Turn over to you, Dan, for an introduction.
Thank you, Stephen. Can everybody hear me okay? Good. I appreciate you all having me here. Slight change to my title recently. I'm now currently the acting chief of staff to the agency's director, Sandra Thompson. I still have my climate change and ESG hat on, so that's good. You know, as you all have mentioned, climate-related financial risks and their solutions are important for all of us. And at FHFA, we treat this as a priority. We recognize that climate change affects the lives of many. It increases risks of property damage and exposes the housing finance system to potential financial risk. We also recognize that it may have disproportionate effects on vulnerable communities and households that are too resource constrained to make climate resilient improvements to their homes or to recover from damages. While I can't go into any future policy or programmatic changes, I can talk a little bit about what we have been doing and what we're doing now. We have in early 2022, we established a steering committee and that consists of the top agency officials and a series of 8 supporting working groups. Those are related to specific areas of focus, and these working groups contain staff from all around the agency. So it's important because everybody needs to be aware of and understand and adapt to the consequences of climate change. So we have a data and research working group. We have an assessing exposure working group. They do scenario analysis and climate-related stress testing. We have a governance working group. We have a working group related to green bonds, one related to reporting and disclosures. Kelsey mentioned those earlier. Also mentioned earlier was our consumer protection working group. We have a legal working group that helps all the other working groups. And then we have an agency operations working group, specifically looking for ways that FHFA can lead by example by reducing its own climate footprint. Another thing I should point out is that this past year, our reporting and disclosures working group formed a sub-working group dedicated specifically to understanding how to measure greenhouse gas emissions. This is critically important because of the SEC's pending rule and also the developments in California. A couple of highlights. In 2023, we published 2 climate-related working papers on our website. One was a literature review of all the work that's been done in this space. And the other one is an analysis of how natural disasters affect transportation infrastructure and then consequently home prices. We have more papers in the pipeline, and you'll see them coming. On October 3rd, we had our second Econ Summit devoted specifically to climate risk, and we had sessions on climate change and insurance, land use regulations, disclosures, and risk modeling, along with another one devoted to disaster risk and the effects on house prices. At that summit, we had almost 300 stakeholders across the government, industry, and academia in attendance. In November, over the 14th and 15th, we had an insurance symposium focused on single-family insurance challenges. We brought together insurance commissioners, insurance and reinsurance companies and trade associations, consumer advocacy groups, and other industry stakeholders, including lenders, servicers, and a whole host of folks to talk about not only what they were seeing in their worlds, but also really to come up with solutions. We asked each panel, what do you think are some solutions? So it was a very well attended event. We had roughly 500 people attend, either online or in person. And it's the beginning of a number of symposia that we will have. This one in November was devoted to single family. We're planning another one in, I believe, March to address multifamily insurance issues. In terms of reporting, as many of you know, in June of 2023, Fannie Mae released its 2022 ESG report. And in September of this year, Freddie Mac released their 2022 sustainability report. These reports provide details about Fannie and Freddie's sustainability strategy, activities, and performance. In terms of climate risk assessments, we've made significant progress with the enterprises on continuing to explore climate scenario analyses. This year, the focus was on acute physical risks and refining these methodologies. And we hope to expand these scenarios to include other perils in the future. Let me just mention another thing that I think Kelsey mentioned. We do work very actively with other parts of the government. We do believe that addressing the risks of climate change is it requires kind of all of us to be involved in this. So in our space, As mentioned earlier, we work closely with the FSOC's Climate-Related Financial Risk Committee and their sub-working groups. We're contributors to those sub-working groups, and we sit in on the advisory committee that works with them as well. We're also active in the network of central banks and supervisors for greening the financial system and their sub-working groups, the NGFS. We also are a participating member in the Treasury's Financial Literacy and Education Commission, or FLEC. And in May of 2023, we joined the Mitigation Framework Leadership Group, which is chaired by FEMA. I think, there's a lot of things that I can't necessarily go into great detail about, given the confidential supervisory nature of much of what we do. But I want to stress this point. At the end of 2021, then Acting Director Sandra Thompson stated that climate change is a priority for the FHFA and for all of its regulated entities. And she has backed that up by supporting the work of our working groups and by reiterating it, this prioritization to all of her regulated entities on a fairly regular basis. So we are full steam ahead on trying to understand the implications of climate risk and to find ways for Fannie, Freddie, and the federal home loan banks to be constructive forces for good in this effort. And Stephen, I hope I didn't talk too long.
Not at all. You shared a lot of information, and from the papers to the conferences to the work groups to the initiatives, starting at the top, you've identified them, and all that is very important, to be honest, a role model. Talk about why it's so important. And, from the direct risks, physical risk, transition risk, mortgage default, climate mitigation, price volatility, what are you seeing? Because again, this idea that climate is a financial risk, how have you already seen it, or how are some of the folks thinking about it may be affecting, as you say, particularly low-income families?
Yeah, thank you, Stephen, for that question. We see it every day. The statistics that we saw earlier that Kelsey raised, the number of natural disaster events causing over $1 billion in damages, inflation adjusted, I would add. That number keeps going up. There are also compelling charts that show the number of events that cause significant damage that are below that threshold, and they're just all going in the same direction. So, as Director Thompson said recently, she's seeing that the direction of climate change is going in one direction only. It's going from bad to worse. And so, she's raising the red flag about insurance difficulties, as you see insurance companies pulling out of states and regions. That's the kind of, if you knew nothing about climate change and you saw that happening, you might think, what's going on here? And it is, in a very real sense, it is the canary in the coal mine here. This is the screaming damage indicator that we all should pay attention to. And so the entities we regulate are specifically concentrated in one type of asset, and that is mortgage collateral. And the key for all of that system to work smoothly is that we have to have a viable insurance mechanism, and we have to have the ability to have those mortgages be bought and sold as they are, and so this is and yet we're seeing things like sea level rise and higher damages being caused by these natural disasters. So while insurance is just a tip of the, I dare say it, the iceberg, it is a leading indicator of change. So we're confronting this, and we're being confronted by these developments. And here's another thing. Fannie and Freddie and the home loan banks are required to purchase mortgages across the country. So the home loan banks in their districts, Fannie and Freddie across the country. So they can't just, say, well, we're not going to buy these mortgages or that. They have to keep providing this service. And the key is, how do they do that? And how can we protect Fannie and Freddie? Sure, we have to do that. But most importantly, we have to protect the American homeowner and renter from the challenges that are presented by climate change. So we have to think for ways that we can make the housing stock more resilient, more energy efficient, because those things will help protect the person living in that home or apartment from the damage caused by these increasingly ferocious natural disasters. They will also, if we make these entities more energy efficient, they will help deal with the fact that the global temperatures are rising, the air conditioners are running more and more, and so costs of maintaining a home keep rising. There are costs associated with making these changes, and so we're looking for ways we can overcome those costs, right? Help the borrower or the homeowner or the multifamily property owner absorb, kind of be able to pay those costs. So we get to the other side of that fixed cost and see the lower carrying costs over time.
I'm sorry.
Ahead.
No, I apologize, yeah.
No, I was just going to say that's the challenge before us, because when you look at trying to make the housing stock more resilient, more energy efficient, what a lot of people see is just, well, that's very expensive and we can't do that. And we're not looking to increase the cost of home ownership for the American homeowner or renter or borrower, but we do want to get these improvements made in a cost-effective way so that they can benefit from that over the time they own that home or rent that apartment. The thing with Fannie and Freddie and the home loan banks is that we see a property for a very, very long period of time. It's not just as one entity trying to build something and perhaps sell it off. We're going to see the first owner, that mortgage may come to Fannie or Freddie, and then when they sell it and buy another house, we'll probably see the second owner and the third owner. So the risks of that property are going to be risks to Fannie and Freddie that we need to protect. And it's really ultimately about protecting Fannie and Freddie, but also the American homeowner and renter from the damages caused by climate.
Yeah. We could spend the whole time just talking about insurance. Let me just ask a question, ask for a quick answer back, and then move on to another topic. And you've talked about what Fannie and Freddie and the home loan banks can do in promoting resiliency, energy efficiency. And there's a lot, obviously, the insurance sector has to do, the reinsurance sector has to do, the state regulators. We did a report with a variety of ideas, including parametric insurance. Are there other things that you think FHFA or your entities can do in the short term on insurance before I move on to the next topic?
I think, one of the things about that we've heard is how to get insurance companies to recognize the resiliency improvements or energy efficiency improvements and translate that into lower rates. There's great power in what Fannie and Freddie can do because they can move the market in a volume sense. And I think that might be something, if we can figure out a way to incentivize these resiliency improvements, that might help move the needle in terms of insurance companies being willing to lower the rates to recognize that increase in resiliency. What does that mean? If you get a whole neighborhood to reduce their wildfire risk by changing the nature of foliage all around the community, maybe that will move the needle with the insurance companies a little bit more than just one house doing it. So I don't know if that answers your question, Stephen, but that's my best guess at how to do
That
that.
absolutely. Actually, this weekend I was talking to a relative who is a firefighter in the forest out west, and that would make an enormous difference, just as an example of that. So you're in conversation daily or regularly with the regulated entities, with Federal Home Loan Bank. What are the questions they're asking? What are the concerns? Where do they see this as an opportunity? Not insurance, the broader climate risk issue.
I think what they're trying to figure out that they're asking themselves, and we're asking them is, where are you exposed? How does your exposure change over time? So that gets to a lot of the scenario analysis that we're having them do. We don't want to just run the regular NGFS scenarios. When you get entities like Fannie Mae and Freddie Mac in particular that are so widely diversified across the country, it's really hard to move the needle if you say, well, what if temperature rises by this amount and it results in some more storms and more natural disasters and more drought, et cetera. So what we're really trying to do is just figure out how sensitive the enterprises are to climate-related stresses. So what does that mean? It means a lot of what-if questions from me. That's one of the things it means. What if we had, 3 Hurricane Harveys and a Sandy inside of a given year, and that happened when we were having a recession? Now, I know that's way off into the tail of the distribution, as the modelers would tell us, but that's the kind of questions I think we have to ask. We have to make sure that the enterprises and the home loan banks can continue to achieve their housing finance mission of making housing available to all Americans in an equitable way, regardless of what happens to the climate and to the economy. And so that's some of the things we're asking them is just, how can you do this? How can you do that? We're also, in our consumer protection working group, we're asking the enterprises to evaluate the effects of their policy changes on vulnerable communities. This is a big deal. This is a framework that we have asked them to put in place. And Lita Bloomfield of our consumer protection working group has a blog up on our website describing some of this work. So that's a big question we're asking. How do we help the most vulnerable among us deal with climate change? And it's difficult because there's a century of redlining that put vulnerable communities in the most climate vulnerable areas of the country, and so we've got to figure out solutions there. Part of the answer, I think, is, and we're also asking, what if, God forbid, there's a Minsky moment where all of your assets are suddenly dropped in value? The market acts in strange ways. They can have the same information day after day, month after month, year after year, and then at some moment that none of us can predict, they can adjust to that information. And so we need to make sure that the enterprises can deal with that. So that's a little bit of the questions that we're asking, Stephen. I hope that has helped.
No, it does. And when you think about the scenario analysis, which is so important, I mean, just to follow up on what Kelsey said earlier, if someone had said, in the 1980s, the country had $1 billion storm every 4 months. And so if the FHFA back then were planning, today it's every 3 weeks. So that would have said, oh, that's too far away from the scenario analysis. And we all know the climate. And if someone had said even 5 years ago, oh, the insurers are going to be dropping out, literally serving millions of customers less within 1 year, they would have said, oh, no, that's too far off the end. So I think what you're doing in scenario analysis is important, and I would and encourage that. In maybe 60 seconds, maybe give 1 or 2 examples of something positives come out of here, that you've seen leadership, either obviously lots of great stuff you've mentioned, FHFA, from Fannie or Freddie or the Federal Home Loan Banks, something they've done that has actually been helpful, whether it be serving those most vulnerable or overall for the institutions, briefly.
Yeah, so as Kelsey mentioned earlier, Fannie and Freddie have incorporated climate change considerations into their equitable housing finance plans. That is among the most positive things I've seen, because that tells me they're really paying attention to this, especially with respect to the vulnerable communities that were so intent on trying to help. That means a great deal to me. We're also doing a lot in the way of starting to understand what people think about climate change. And while that sounds a little bit of a kind of a researchy type of a question, Fannie Mae has done a survey. We're working on the American Survey of Mortgage Borrowers. This year, it's already out in the field starting in October. And what we're doing there is trying to understand how people think about climate change and flooding and other perils. Why is that important? Because we have to meet people where they are. You know, we have to get the ability to explain to folks the risks that their homes may be subjected to. You know, we had an insurance symposium in November, as I mentioned, and there was an individual who spoke there who said, well, you know, the information's available in every state, and all the consumer has to do is look it up. Well, that's not so easy to do, right? So I think
it's not.
one of the things we have to do is we have to, you know, I think of climate a lot like I think of food labeling. Get the information out to consumers and they'll start to absorb it. And over time, they'll make better decisions. I'm sorry.
Dan, I would love to spend the rest of the afternoon just talking with you, but I am with deep thanks for both being here today and for everything you and your many, many, many colleagues at FHFA are doing. I'm going to turn it back to Kelsey and Holly for other questions and wrap it up. Kelsey and Holly.
Thank you, Dan. Thank you, Stephen, for the very insightful and inspiring discussion. We are getting so many questions from the audience. But Kelsey, you are the author and we have your top scoring agencies here. Before we go to the audience, if we have time, do you have any questions for Dan?
I think Stephen covered most of them. Let's try and hit some of these in the chat.
Great, thank you. So one of the questions is from Edward. He asked about the US banks and financial institutions seems to be lag behind our EU counterparts on stress testing and climate scenario analysis. So Dan mentioned a little bit about this on the FHFA work, but we also have other banking regulators who's working on this. Can you share some of insights? Thank you.
Well, I can't talk about what other bank regulators are doing. I can just tell you that, you know, we meet with our other regulatory colleagues. The Fed had their exercise, and you know, all of us are a little bit, you know, new. All of us are new in this area, so I think we're all trying to do the best we can. Part of the way you run scenario analysis in a meaningful way is you get really disaggregated data, and that's harder than it may appear. So yeah, I do understand that other jurisdictions are making great progress. That's the benefit of us being a member of NDFS. We get to hear about that progress and try to learn from it, adapting to the specifics of the US system. I hope that's helpful.
Yeah, just to add on to that a little bit too quickly, the Fed in particular has a different mandate than a lot of the countries do in Europe, the central banks in Europe. So that also has a little bit to do with it. Although on the positive side, the larger banks in the US are often already conducting scenario analysis for those regulators in Europe, you know, different branches, but they at least have some experience behind that, which will hopefully allow the US to get up to speed faster than we otherwise would.
Thank you. We have Gina asked about CFAX materiality. That is too bad that Sandra has left, but we'll get back to the questions maybe later in our website. You can find more information there. Last question from David. He asked about the insurers to take into account climate risk mitigating by the communities, states, and federal government. One major problem is that home insurers in their underwriting do not take into account of the wildfire risk reduction benefit of landscape and scale forest treatment, even though it's technically feasible for insurance underwriting and pricing model to do so. So there are ample specific evidence on the risk reduction benefit from forest treatment, and the federal, state, and local governments, utility, and HOAs are collectively sending billions on forest treatment. So for years, they have been waiting for the insurance to take up this vulnerability. Dan, Stephen, do you have any thoughts, insights?
Yeah, I will just in 30 seconds, I know we're about to run out of time, that there is a firefighter task force working through the California Insurance Department. There's some other works with the National Association of Insurance Commissioners. And I encourage people to reach out to us. We're happy to give them more information. This is a big, important topic that we don't have time for today. Holly, we'll turn it back to you for closing.
Thank you. Kelsey.
We have a few resources that we can share with you on our website. If you can see those here for our reports, any new reports that come out, our Freedom to Invest campaign. And if you would be so kind, we would greatly appreciate your feedback on this webinar. And again, we'll be sharing these slides and the recording with you. Thank you all for being here. Have a good afternoon and holidays.